Audit sampling, an overview and application to tests of controls. Welcome to the wild world of audit sampling, your backstage pass to a realm where mathematical precision meets professional judgment. I'm your guide through this 60-minute journey where we'll crack open secrets that separate the rookies from the veterans in this game. You might be thinking, it's just sampling, how exciting can it get? Oh, you'd be surprised. Just last month, the SEC charged that major tech company with improper revenue recognition because their sampling of contracts was fundamentally flawed. One sampling misstep can be the difference between catching fraud and letting millions walk out the door unnoticed. Let's dive in. As I always tell my clients, sample smart or prepare to restart. Let's make sure you don't learn this lesson the hard way. Look around at your classmates. Statistically speaking, at least 2 of you in this room will face a major sampling decision in your first year on the job that could make or break an audit. Will you be ready? By the end of this hour, my answer will be a resounding yes. Roadmap and learning objectives. We're going to uncover the basics of audit sampling, explore statistical versus non-statistical approaches, and master the art of attribute sampling for control testing. No fluff, all substance. By the end, you'll see sampling not just as a technical procedure, but as your secret weapon in the audit arsenal. Our learning objectives today. Understand why sampling remains essential in modern auditing. Distinguish between statistical and non-statistical sampling approaches. Apply attribute sampling to tests of controls. Evaluate sampling results to make proper audit conclusions. Think of this lecture as your sampling survival guide. In the words of Effie Trinket from the Hunger Games, may the odds be ever in your favor. Except in our world, we don't leave odds to chance. We calculate them precisely. Before we dive deeper, quick poll. How many of you have performed audit sampling in an internship or previous class? Keep that experience in mind as we go through today's material. You'll see how theory connects to what you've already done. For those of you headed to public accounting internships next summer, listen up. The Big Four firms are currently implementing new AI-assisted sampling tools, but guess what? These tools still require you to understand the fundamentals we're covering today. The machines aren't replacing sampling judgment, they're just making the math faster. And for those new to sampling, buckle up. This is where the rubber meets the road in auditing. Master this, and you're well on your way to becoming the audit superstar every firm wants to hire. The stakes are real. Heard about Silvergate Bank? In early 2024, their collapse sent shockwaves through the financial world. One of the key issues? Inadequate sampling of high-risk transactions in their crypto business. Their auditors didn't catch the concentration risk because their sampling methodology wasn't designed to detect it. It's like that meme where the dog sits in a burning room saying, "This is fine." Except in auditing, it's not fine. And the fire is usually millions of dollars walking out the door. The consequences of poor sampling aren't theoretical. They're real, they're costly, and they're career-defining. One sample too small might be the difference between a clean opinion and a restatement that tanks the stock. As Drake would say, started from the bottom of the sample size table, and now your client's whole team's here in bankruptcy court. Think about a recent financial scandal in the news. Jot down how proper control testing might have prevented it. We'll come back to this idea later. Modern audit environment. First, let's define what we're talking about. Audit sampling is the application of an audit procedure to less than 100% of items in a population to draw conclusions about the entire population. Think of modern auditing like fishing in an ocean. Back in the day, you'd cast a wide net and hope for the best. Now, with technology, you've got sonar that shows you exactly where the big fish are, but you still need to throw that line in the water to catch them. Audit sampling is that line, because even with all our fancy systems and AI, we still need to roll up our sleeves and check the actual transactions. Why? Because technology doesn't eliminate the need for human verification. It just makes it more targeted. What about automated systems versus human processes? Automated systems still need control testing. They're just designed differently. And for physical inspections and third-party confirmations, you can't digitize those away. Controls, 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 and controls, controls. Be sure they're real or they might just vanish into thin air. Audit evidence when sampling applies. Let's talk about when you'll actually use sampling in your audit work. It applies to several common evidence gathering procedures. Inspection of tangible assets. Those dreaded inventory counts where you're trying to figure out if 1,000 widgets are actually there. You can't count every item in a massive warehouse, so you sample. As I always say, count what counts, not everything in sight. Inspection of documents. Matching invoices to shipping documentation. When there are thousands of transactions, sampling is your lifeline. Or as I told an intern last week, you want to go home before midnight? Learn to sample. Reperformance of controls. Recalculating those reconciliations to see if the control is working. Did they really check what they said they checked? The proof is in the pudding, or in this case, the sample. Confirmations. Like receivables balance verification, where you're reaching out to customers to verify balances. You think Tesla's going to confirm all 10,000 of their vendor balances? Dream on. Think of sampling like TikTok's algorithm. It doesn't analyze every video for your specific preferences. It samples your viewing patterns to make educated guesses about what you'd like. Similarly, sampling gives us a reasonably accurate picture without reviewing everything. Remember what my first partner told me. A good sample is like a good movie trailer. It doesn't show everything, but it gives you enough to know what you're getting into. Words to live by, people. Deciding whether to sample or test entirely. Either we control the sampling or the sampling controls us. Either we test smartly or we drown in documentation. Picture this. You're auditing cash. Do you sample every single transaction? That's like reading every tweet ever posted to understand Twitter. Instead, focus on the big ones. The Taylor Swift concert tickets of your audit, not the coffee receipts. Let's break down 3 key scenarios. Testing all items. When should you examine 100% of a population? When a few large items constitute most of the account balance. When the population is very small, like just 20 transactions. When regulations require complete testing. Just a few items. When might a tiny sample be appropriate? When dealing with highly automated systems, test the controls and a small sample. When using a high-risk, high-value approach, focus on the big stuff. When conducting preliminary assessments before detailed testing. When not to sample at all. If a controlled test is done only once or twice annually, test 100%. If you have analytical evidence that's more efficient than sampling, if the risk is so high that only 100% testing provides sufficient assurance. I once had a senior who insisted we sample 60 items from a population of 65 transactions. I gently suggested we just test all 65. But the sampling methodology? He started. I replied, sometimes common sense trumps methodology. We had a good laugh, and I saved myself 5 whole documentation steps. Take a minute. Jot down in your notes. If you had to audit all vendor payments, but only had time to test 60 transactions, how would you decide which ones to pick? Keep that thought. We're about to blow it wide open. Statistical versus non-statistical sampling. What looks like a dull choice between 2 sampling approaches is actually the entire foundation of your professional credibility. As Kendrick Lamar might say, sit down, be humble, especially about your sampling choices. Statistical sampling is like having GPS. It tells you exactly how lost you might be. Your sampling risk, quantified. Your sample size, mathematically determined. Your defense if questioned, bulletproof. Non-statistical sampling is like asking a local for directions. It might work perfectly, but if you get lost, good luck explaining to the partner why you took that route. It felt right doesn't play well in a PCAOB inspection, folks. I once used non-statistical sampling on an engagement and couldn't sleep for a week worrying if I'd missed something. The client was a cryptocurrency exchange with millions of transactions. Talk about high stakes. Next time, I hit those statistical tables like my career depended on it, because it did. Statistical advantages, quantifiable risk, defensible methodology, explicit precision. Statistical disadvantages, more complex, sometimes larger samples, requires more technical expertise. Non-statistical advantages, flexibility, potentially smaller samples, relies on judgment. Non-statistical disadvantages, can't quantify risk precisely, harder to defend if questioned. Let me drop some truth on you. Sample with math or face the wrath. That's a little sampling poetry I just made up, but you better believe it's true. Overview of statistical sampling techniques. We identify the right technique. We select the proper sample. We analyze with professional skepticism. We conclude with confidence. Let's break down the three major players in the sampling game. Attribute sampling, your go-to for controls testing. Did each invoice have proper approval? Yes or no, black or white, passed or failed. Estimates rate of occurrence, proportion, of a certain characteristic. Monetary unit sampling, MUS, the Beyoncé of substantive testing. All about the dollars, with bigger balances automatically getting more attention. Estimates dollar misstatement and is often favored for substantive testing. Classical variables, sampling. The OG approach treats all balances equally, like the audit equivalent of socialism. Also for estimating dollar misstatement, but a more traditional approach. Let's play a quick game I call Match That Sample to make sure we're getting this. I'll describe an audit scenario and you call out which sampling approach fits best. Scenario 1. You need to test whether sales transactions over $10,000 received proper credit approval. Scenario 2. You're testing accounts receivable balances for overstatement. Scenario 3. You're examining inventory quantities with both high and low value items. Last year, I was consulting on an audit for a major streaming platform. They were verifying subscription revenue with millions of subscribers paying anywhere from $6.99 to $19.99 monthly. The audit team initially chose attribute sampling to test the subscription control process. I suggested they reconsider and use MUS instead, since the dollar values varied significantly, especially with their new premium tier, just like Netflix's just launched $30.99 ultra premium tier. This simple switch reduced their sample size by 30% while providing better coverage of high-value subscriptions. The partner literally high-fived me. Remember this. The right sampling approach saves time, money, and your weekend plans. That's not just an audit tip, that's life advice. Attribute sampling basics. Attribute sampling's primary use is to evaluate how often a control is deviated from. Think of it like this. Did each invoice have proper authorization? It's a yes/no question, not about dollar values. Yes or no. Pass or fail. Authorized or unauthorized. Black or white. No gray area, people. This approach is like a quality control inspector at Apple checking new iPhones. They're not measuring how much each phone is worth, monetary value. They're checking if each phone meets specs, attribute. The new iPhone 16 either has working Face ID or it doesn't. There's no kinda working Face ID. What makes attribute sampling powerful is how directly it links to concluding on control effectiveness. If the deviation rate is low enough, you can rely on the control. If not, you can't. I once tested purchase approvals at a manufacturing client and found a batch of invoices all authorized by someone named Acting Manager. Turns out this mysterious person didn't exist. It was just various staff signing whatever they wanted when the boss was on vacation. The purchasing manager literally created a fictional character to approve purchases. Talk about creative accounting. This wasn't just cooking the books. This was a 5-star fictional feast. But it taught me that attributes can be faked, and sampling helps us catch these creative characters. Remember what I always say, where the controls fail, the auditors must prevail. Or as they say in The Godfather, keep your friends close, but your attribute samples closer. Okay, I might have tweaked that quote a bit, but you get the point. Monetary unit sampling, basics. Monetary unit sampling, MUS, uses attribute sampling logic, but for dollar values. It's like attribute sampling put on a designer suit and got an MBA. Same foundation, but fancier and more focused on the money. The magic here is that MUS automatically emphasizes larger balances, since each dollar gets an equal chance of selection. That means a $10,000 invoice is 100 times more likely to be selected than a $100 invoice. It's dollar democracy. $1, 1 vote. Let me illustrate. Imagine you have 1,000 accounts receivable balances. One is $1 million, and the others average $1,000 each. With MUS, that $1 million account has a roughly 50% chance of being selected in any reasonable sample. With classical sampling, maybe 0.1% chance. See the difference? Advantages of MUS automatically emphasizes larger balances, where the risk usually is, particularly effective for populations with very few high-value items, can often result in smaller sample sizes than other methods commonly used in accounts receivable and inventory testing. Quick thought experiment. If you were testing for overstatement in accounts receivable, which sampling approach would serve you better, MUS or attribute sampling? Jot down your answer and we'll revisit this later. Classical variables, sampling. Classical variables sampling is the traditional approach that predates MUS. It's like vinyl records in the streaming age. There are reasons some auditors still prefer it for certain situations, and it's making a comeback in specialized areas. The goal of classical variables sampling is to estimate the true balance or amount of misstatement in an account. You're not just asking, is this transaction correct? But by how much is this account misstated? Unlike MUS, which puts each dollar in the spotlight, classical variables sampling includes both large and small balances uniformly. It's the equal opportunity employer of the sampling world. It doesn't discriminate based on size. Each transaction has the same chance of selection regardless of dollar amount. When might you use this approach? Let me break this down with a real-world example. Remember Rivian, the EV manufacturer that just announced their new R2 model? They're facing major inventory challenges with varying component costs. Their CFO told analysts last month that they're struggling with both overvalued and undervalued inventory items. If you were auditing Rivian, MUS would be great for finding overvalued items, since it favors high dollar values. But it wouldn't help much with undervalued items. This is exactly where classical variables sampling shines. It gives equal attention to potential understatements. There are actually 3 types of classical variables sampling. Mean per unit estimation, sampling to estimate the total value. Difference estimation, sampling to estimate the difference between recorded and audited values. Ratio estimation, sampling to estimate the ratio of misstatement. Early in my career, I was testing inventory at a jewelry store. The senior suggested classical variables sampling instead of MUS because we were concerned about both expensive items being fake, overstatement, and valuable items being missing from inventory, understatement. The partner questioned our approach until we found 3 small value items that were significantly undervalued. They were actually rare collector's pieces worth 50 times their recorded value. Had we used MUS, we never would have selected those items. For those of you interested in specialized industries like art collections, cryptocurrency holdings, or collectibles auditing, classical variables sampling might become your secret weapon. It's not just an old technique, it's a classic for a reason. Attribute sampling applied to controls. Overview. Now we're getting to the good stuff. Attribute sampling for controls testing follows 3 critical phases. I call them the plan, perform, evaluate trinity of sampling. Plan, perform, evaluate. Plan, perform, evaluate. Plan, perform, evaluate. Burn it into your brain like that catchy song you can't get out of your head. In the planning phase, we define our objectives and parameters. In the performance phase, we select our sample and test those items. In the evaluation phase, we analyze results and draw conclusions. You can't skip any phase. I once had a junior auditor who thought they could jump straight to performance. They ended up testing the wrong control attribute entirely. That's like showing up to a blind date without knowing the person's name or what restaurant you're going to. Here's a quick exercise. Pull out your phones. Yes, I'm actually asking you to use your phones in class and open the calculator. Input your birth month times 25. That's your hypothetical population size. Now divide by 12. That's your sample size. Got that number? Look at the person next to you. If your number is higher, you're planning a bigger sample. But is bigger always better? That's the million-dollar question in sampling. Think of these 3 phases like building a house. Planning is your foundation. Without it, everything collapses. Performance is your frame and walls, the visible work everyone notices. Evaluation is your roof and finishing touches. It protects all your hard work and makes it functional. Remember what I always say. Plan like an architect, perform like a craftsman, evaluate like a home inspector. Each role requires different skills, but all 3 are essential to success. Planning phase, objectives, and population. You know how you feel when you start a Netflix series without reading the summary first? Completely lost. That's what happens when you sample without properly defining your test objective. What exactly are you testing? Are purchase orders properly approved? Are credit limits checked for new customers? Be specific. Vague objectives lead to vague conclusions, and vague conclusions lead to partner disapproval. Population. What's in? What's out? All purchase orders over $10,000? All new customers from quarter 3? Define boundaries. I've seen auditors accidentally test transactions from the wrong year because they didn't define their population properly. Sampling unit, the individual record or document item you'll examine. Is it the invoice, the line item, the customer file, the authorization signature? Deviation conditions, what counts as a fail? Missing signature, no evidence of review, wrong approval level, undocumented exception. Think of these definitions as your treasure map. Without clear X marks the spot instructions, you'll be digging random holes all over the island. And the partner will not be pleased with your intuitive approach to finding gold. This stack represents all the purchase orders for the year, your entire population. But maybe you only care about POs over $50,000. Now our population is more targeted. Next, we need to define what we're looking for. If we're testing for proper approval, our deviation condition might be missing CFO signature on POs over $50,000. That's specific and testable. A few years ago, I was reviewing work papers for a junior auditor who defined their population as all significant transactions. When I asked what significant meant, they said, "You know, the important ones." Needless to say, we had to start over. Always quantify your population definitions. Take a minute and jot down a population definition for testing expense approvals at a company like Tesla after their recent layoffs. Would you include all expenses or just certain types? What date range would you use? What approval thresholds might matter more now that they're cutting costs? This exercise might seem simple, but it's exactly what real audit teams are doing right now for Tesla's year-end audit after their major restructuring. Planning, tolerable and expected deviation, confidence. Don't put the cart before the horse, folks. Once you've defined your objective and population, you need to nail down 3 critical parameters that will make or break your sampling approach. Desired confidence level, usually 90% or 95%. This is how sure you want to be about your conclusion. Higher confidence means larger sample sizes. It's like the difference between pretty sure and darn sure. Tolerable deviation rate. The maximum error rate you can accept and still rely on the control. If you're testing a critical control, you might set this at 5%. Less critical controls might get 8 to 10%. Think of this as your pain threshold. Expected deviation rate, what you anticipate finding based on past audits or preliminary testing. If you found 2% last year and nothing changed, start with 2%. This is your educated guess about how well the control is working. Remember how Spotify Wrapped tells you your listening patterns at the end of the year? Those are based on samples of your activity, not every single song. The confidence level is how sure Spotify is that those samples represent your true listening habits. Let's try a quick sample size calculation. Pull out your phones and follow along. If we have 95% confidence level, 5% tolerable deviation rate, 1% expected deviation rate, using the standard formula in your textbook, our sample size would be, that gives us 59 items to test. But watch what happens if I change just one parameter. Let's bump the expected deviation rate from 1% to 2%. Now we need 93 items. That's a 57% increase in sample size from just one parameter change. I once worked with a senior manager who set the expected deviation rate at 0 for every test. We shouldn't expect errors, he'd say. Then when we'd find just one deviation, we'd have to expand our sample size dramatically. Don't be that auditor. Be realistic about expectations, or you'll be testing until midnight. Here's my sampling rule of thumb that served me well for 15 years. For higher risk areas, aim for 95% confidence. For medium risk areas, 90% is typically sufficient. For low risk areas, 80% is usually sufficient. Areas with good prior results, 85% might be acceptable. Remember, conservative parameters protect your weekends. Aggressive parameters protect your time, but risk your conclusions. Choose wisely. Performance, selecting the sample. Picture this. You're standing in a room with 10,000 invoices. How do you pick just 60 to test? This isn't eeny, meeny, miny, mo, or the TikTok put a finger down challenge. We need proper selection methods. 2 main approaches. Random number selection, like drawing lottery numbers. Generate random numbers between 1 and 10,000, then pull those invoices. Even the recent $1.3 billion Powerball winner had better odds than finding fraud without proper randomization. Systematic selection, take every nth item. Calculate your sampling interval, population divided by sample size. If it's 10,000 divided by 60 equals 167, you take items 167, 334, 501, and so on. The key principle? Every item needs a chance of being selected. I once saw an auditor pick random samples by gravitating toward neat handwriting. Can you guess how that audit went? About as well as my attempt to recreate a TikTok dance, disastrous and slightly embarrassing. Listen up, because this is gospel. Random isn't whatever you feel like grabbing. Random means every item has an equal, calculable chance of selection. Write that down in big, bold letters. And before you ask, no, you can't just grab the first 60 items because they're representative. That's like saying you understand an entire Netflix series from just watching the first episode. Performance conducting tests. Now that you've selected your sample, you need to examine each item for the defined deviation conditions. Let's get practical about what this actually means. When testing a control, you're looking specifically for evidence that the control operated as designed. For an approval control, you're checking for the authorized signature, proper date, before transaction execution, and appropriate authority level. Quick scenario. If you found a voided document in your sample, what would you do? Great answer. Typically, you'd replace it with another randomly selected item, unless it looks suspicious. If a document is suspiciously voided, that's a red flag to investigate. If an item cannot be examined, maybe it's missing, count it as a deviation unless you can perform alternative procedures that give you the same assurance. Last month, I was consulting on an audit for a Fortune 500 retailer implementing Workday financials, similar to what Amazon is doing with their financial systems. During testing, we discovered that 3 out of 60 approval documents couldn't be located. The client said, "Trust us, they were approved." But in audit, "Trust me, bro," isn't evidence. We had 2 options: count them as deviations, potentially failing the control, or perform alternative procedures. We chose option 2 and examined the approval metadata in the system logs. This confirmed the approvals had occurred but weren't properly documented, a documentation deviation rather than a control failure. This brings me to 3 golden rules of test execution. Consistency is crucial. Test every sample item exactly the same way. Objectivity is non-negotiable. Don't rationalize away deviations. Documentation is your defense. If it isn't documented, it didn't happen. Pro tip. Consider stopping early if you find numerous deviations. I once kept testing a control after finding 8 deviations in the first 20 items. The partner asked why I wasted time testing all 60 when we clearly couldn't rely on the control. Time is money, people. Or, as I like to say, when deviations accumulate, testing should terminate. Here's a tough scenario. You're testing a control and found 3 deviations in 40 items. Your tolerable rate is 7%, so you're at 7.5%, just barely over. The client review notes explain the deviations as unusual circumstances. Do you A. accept their explanation and pass the control? B. count them as deviations and fail the control? C. expand your sample to get more evidence? The right answer is C. Expand your sample. Never compromise your ethics by ignoring deviations, but also be fair by gathering sufficient evidence before concluding. Evaluation, sample deviation rate. This is where the rubber meets the road, or where the partner meets your work and decides if you're getting that promotion or that performance improvement plan. First, calculate your sample deviation rate with this simple formula. Deviations in sample, sample size. If you found 3 deviations in a sample of 60, that's 3 divided by 60 equals 5%. But here's the kicker. That's just your sample. What about the whole population? That's where you add an allowance for sampling risk to get the computed upper deviation rate, CUDR. As Jay-Z would say, you've got 99 problems in your population, but you've only seen 60 of them. Let me illustrate this with a quick demonstration. I need 2 volunteers. Student 1 represents your sample. Student 2 represents your population. Student 1, show me 5 fingers. That's your 5% deviation rate in the sample. Now, student 2, show me 8 fingers. That's potentially your true population deviation rate of 8%. The difference between what we've seen, 5 fingers, and what might actually exist, 8 fingers, is our sampling risk. That's why we calculate the CUDR to account for the uncertainty in our sample. The allowance isn't just a random number. It comes from statistical tables based on your sample size and confidence level. The smaller your sample, the bigger the allowance. Think of it as the uncertainty tax you pay for not testing everything. I once calculated a QDR of 7.1% against a tolerable rate of 7%. That 0.1% difference cost the client an extra week of substantive testing and me a weekend of work. Decimal points matter, people. Just last month, a major financial institution failed a regulatory stress test because their CUDR on loan approval controls exceeded the tolerable rate by less than 1%. That tiny margin triggered millions in additional compliance costs and a 15% stock drop. That's the power and danger of sampling evaluation. Evaluation, concluding on the control. Once you have your CUDR, it's time for the moment of truth. Compare the CUDR to your tolerable deviation rate. If QDR greater than tolerable, control not relied upon. If QDR less than or equal to tolerable, continue relying on control. Either the control works or it doesn't. Either we rely on it or we don't. There is no kinda works in control testing. Let me walk through this with real numbers on the board. Sample size, 60 items. Deviations found, 3 items. Sample deviation rate, 3 divided by 60 equals 5%. Confidence level, 95%. Tolerable deviation, 7%. Using statistical tables for a 95% confidence level with a sample of 60 and 3 observed deviations, our CUDR is 10.2%. Is 10.2% greater than 7%? Yes. Therefore, we cannot rely on this control. This exact scenario happened at a major healthcare company last year. They couldn't rely on their claims processing control, which triggered additional substantive testing of over 200,000 claims. The audit budget exploded. The client relationship became strained, and guess who got to work weekends for a month? The audit team. When a control fails the test, you need to take 3 specific actions. Consider expanding your sample size. Sometimes the QDR is just barely over the tolerable rate, and a few more clean samples might bring it back under. Revise your audit approach. Design more substantive testing to compensate for the control deficiency. Communicate the deficiency to management. They need to fix it, and you need to document that you told them. Here's a challenging scenario I've seen in practice. Your CUDR is 7.1% and your tolerable rate is 7.0%. The senior suggests rounding down to 7.0% to avoid additional work. What would you do? The right answer: never compromise your integrity for convenience. As I always say, rounding and sampling is like rounding the corners on a stop sign. Technically possible, but definitely dangerous. Remember this: where the controls fail, the evidence must prevail. In other words, if you can't rely on controls, you need more substantive evidence. It's a zero-sum game. The audit opinion doesn't care about your schedule or the client's budget. It cares about sufficient, appropriate evidence. Illustrative example: Calabro Wireless Services. As I always tell my students, the devil's in the details, but so is salvation. Let me break this down in a way that'll stick with you longer than that last TikTok earworm. Let's apply what we've learned to a real-world example. We're testing the credit approval control on sales service contracts at Calabro Wireless, a company not unlike T-Mobile or Verizon in their practices. Population: 15,000 contracts. That's a lot of small print nobody reads. Confidence: 95%, because 90% confidence is for auditors who enjoy living dangerously. Tolerable deviation. 6%, our threshold for saying this control works enough. Expected deviation. 2%, based on prior year and preliminary results. Based on these parameters, our sample size is 80 contracts. After testing, we found 3 deviations where credit wasn't properly checked before signing customers up for those expensive smartphone payment plans. Our sample deviation rate is 3 divided by 80 equals 3.75%. Seems acceptable, right? Wait for it. Using statistical tables for a 95% confidence level with a sample of 80 and 3 observed deviations, our CUDR is 8.2%. Either the control works or it doesn't. Either we rely on it or we don't. CUDR 8.2%, greater than tolerable 6%. We cannot rely on this control. As Taylor Swift might say, we are never, ever, ever relying on this control. Back to the drawing board on our audit approach. Time to increase substantive testing and report this control deficiency to management. Sometimes the numbers don't lie, even when the client really wishes they would. Non-statistical sampling, determining sample size. As Jay-Z would say, I got 99 problems, but a sample ain't one. If you're using non-statistical sampling with clear professional guidelines, and trust me, if your sampling approach isn't tight, you'll have way more than 99 problems. In non-statistical sampling, determining sample size is less mathematical but still needs structure. Many firms use standardized guidelines or reference tables based on risk assessment, high, medium, low, frequency of control operation, type of control, preventive versus detective. Prior year results. When I first started, I thought non-statistical meant wing it. My senior saved me by introducing me to the firm's guidance. Sometimes the best sampling approach is the one your firm has already vetted. The key difference from statistical sampling? You can't directly calculate your sampling risk, but consistency across audits is crucial for defensibility. Let me drop 3 golden rules of non-statistical sampling on you. Document, document, document. If you can't explain why you chose your sample size, you might as well not have sampled at all. Consistency is your shield. Using the same approach across engagements gives you defensibility when questioned. Professional judgment isn't whatever feels right. It's applying your knowledge, experience, and firm methodology to make informed decisions. Let's work through this together. You're auditing Meta's user authentication controls for their flagship apps. The control operates millions of times daily through automation. Your risk assessment is medium based on prior year results. Your firm's guidance suggests high risk, 60 samples, medium risk, 45 samples, low risk, 25 samples, but wait, you also need to consider control frequency. For very frequent automated controls, the guidance allows for a 25% reduction. So what's your final sample size? Take a moment to calculate it. That's right. 45 minus 45 times 25% equals 34 samples. This is how non-statistical sampling works in the real world at firms like Deloitte, KPMG, PwC, and EY right now. Non-statistical sampling, selecting items and evaluating. For non-statistical item selection, many auditors use haphazard selection. This isn't random in the statistical sense, but it's not biased either. It's more like close your eyes and point, but with professional judgment. The key is avoiding patterns that might introduce bias. Don't just take the first items in a list, first page bias. Don't gravitate toward neat handwriting, appearance bias. Don't skip items that look complex, complexity avoidance. Don't choose items from certain time periods only, temporal bias. When Apple's auditors test sales transactions, they don't just sample iPhone sales. They deliberately include a mix of all product lines. That's because they know each product line has different revenue recognition risks. This is haphazard selection done right. Let's try a quick exercise. I need a volunteer to help demonstrate haphazard sampling. I'm going to show you a list of 100 numbered transactions on this screen. Without using any systematic approach, select 10 numbers that feel random to you. Great job. Now let's analyze those selections for patterns. Did you pick any numbers ending in 5 or 0? Did you choose any consecutive numbers? Did you pick more from the beginning or end of the list? This illustrates how even when trying to be random, human selection often follows unconscious patterns. In a real audit, these patterns could bias your results. When evaluating results in non-statistical sampling, you can't mathematically determine the upper deviation rate with precision. Instead, compare your sample findings to your expected deviation rate. Use professional judgment to assess the nature and pattern of deviations. Make a binary decision. Rely or don't rely on the control. If your deviation rate is higher than expected, do not rely on the control. Simple as that. As my audit professor used to say, in statistics, numbers tell the story. In non-statistical sampling, you tell the story behind the numbers. And that story better be convincing when the engagement partner reviews your work. The Court of Audit Opinion has no sympathy for weak documentation. Make your non-statistical approach bulletproof with thorough explanations of your selection method, evaluation criteria, and conclusions. Control tests with low-frequency operations. For controls that happen rarely, like quarterly reconciliations, sampling gets tricky. It's like trying to judge a chef based on 4 dishes they make per year. Not exactly a large sample size for Yelp reviews, is it? When a control only operates a few times during the period, your approach needs adjustment. If something only happens 12 times a year, testing 60 items is impossible unless you're auditing in some parallel universe. In these cases, consider 3 options. Testing 100% of occurrences, if very infrequent, like semi-annual process reviews, using a finite correction factor for smaller populations. It's math that adjusts sample sizes downward, supplementing with other evidence types like process walkthroughs and design evaluation. I once had a client who performed their bank reconciliation annually, just once. We couldn't sample that. So we examined that one reconciliation in excruciating detail and added other substantive procedures. This actually became relevant recently with a crypto exchange client whose cold wallet verification happened only twice a year. With billions at stake and FTX's collapse still fresh in everyone's mind, we couldn't just rely on 2 samples. We added detailed procedure reviews, code examination, and even simulation testing. Let's try this scenario. You're auditing a public company where management's review of impairment analysis happens only at year-end. How would you approach this? What would your sample size be? What other procedures might compensate for the small sample? Here's a truth bomb for your careers. Sometimes the most important controls are the ones performed least frequently. Think quarterly board reviews or annual strategy sessions. Don't dismiss them because they can't be traditionally sampled. Adapt your approach. Take SpaceX launches as an analogy. Each launch has hundreds of pre-flight checks. Some happen repeatedly, while others are one-time go-no-go decisions. You can't sample the final launch decision, but you can thoroughly evaluate the process leading to it. Additional considerations and comparing terminology. Software packages like IDEA are to auditors what Photoshop is to influencers. They make our work look better, but you need to understand what's happening behind the scenes. Let me show you this in action. Here's a screenshot from IDEA's sampling module. Notice how they call it confidence level instead of reliability level. Different software might label the same concepts differently. Tolerable deviation versus acceptable error rate, desired confidence versus reliability level, expected error versus anticipated deviation rate, population versus data universe. I once had 2 teams working on the same engagement using different software tools. One team set a tolerable deviation rate of 5% in teammate, while the other set an acceptable error rate of 8% in idea. Guess what happened during the partner review? Complete chaos. We were comparing apples to orangutans. We had to standardize our terminology across the entire engagement team. Take a moment to jot down in your notes. What sampling software does your target firm use? EY uses Helix, PwC has Aura, KPMG uses Clara, and Deloitte has Omnia. Each has its own terminology quirks. As Eminem would say, you better lose yourself in the terminology. The moment you own it, you better never let it go. Okay, I might have tweaked those lyrics a bit, but you get the point. The importance of consistent definitions cannot be overstated. When referencing statistical tables versus software outputs, make sure you're comparing apples to apples, not apples to avocados. Here's my golden rule. Define before you design and clarify before you quantify. This means establishing a glossary of terms for your engagement before you start sampling. Imagine explaining to an audit committee that a control failed because the QDR exceeded the tolerable rate. Their eyes glaze over. Now try saying, the potential error rate is higher than what's acceptable for this critical control. Much clearer, right? Learn to translate audit speak to client language. It's a career-accelerating skill that most auditors never master. Chapter summary/key points. We've covered a lot of ground in these 60 minutes. Let's crystallize the key takeaways with what I call the 4 pillars of sampling wisdom. Write these down, people. Sampling. Relevance. Despite technological advances, sampling remains essential in modern auditing. Technology has changed how we sample, not whether we sample. Even with all the AI and blockchain hype you're hearing about, sampling isn't going anywhere. Risk trade-offs. Remember our sampling risk types: Type 1, incorrect rejection, and Type 2, incorrect acceptance. Every sampling decision involves a trade-off between these risks. In today's regulatory environment with the SEC handing out record fines, most firms are more worried about Type 2 errors. Parameter power, confidence level, tolerable deviation rate, and expected deviation rate drive your sample sizes. Small changes in these parameters can dramatically affect how much testing you do. As I always say, tweak the parameters, change your weekend plans. Method matters. Statistical sampling quantifies your risk precisely, but requires more technical expertise. Non-statistical sampling offers flexibility, but requires stronger documentation of your professional judgment. Choose wisely, young Jedi auditors. Think of sampling like a detective's magnifying glass in one of those true crime documentaries on Netflix. It doesn't show you everything, but it focuses your attention where it matters most. The best auditors know exactly where to point that glass. Remember what we said at the beginning? Where the numbers speak, we must listen. Your sample is telling you something about the entire population. Make sure you're listening carefully to what it says. In my 15 years of auditing, from Silicon Valley startups to Wall Street giants, I've never once regretted taking the time to design a proper sampling approach. But I've definitely regretted cutting corners. Your sampling approach is your audit foundation. Build it strong or watch it crumble. Closing and Q&A. Let's quickly revisit our learning objectives. Check, 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 and check. We've seen why sampling remains essential in modern auditing. We've distinguished between statistical and non-statistical approaches. We've applied attribute sampling to tests of controls. We've learned how to evaluate sampling results to make proper audit conclusions. In auditing, as in life, we can't test everything. The art is knowing what to test and how to test it. Where the numbers speak, we must listen, and where the samples reveal, we must act. Before we wrap up, let me share one last story from the audit trenches. My first year as a senior, I was so nervous about sampling that I oversampled everything. My manager pulled me aside and said, "Sampling isn't about testing as much as possible, it's about testing as smartly as possible." That advice changed my career and saved me from countless late nights at the office. Just like how Beyoncé's Renaissance World Tour sampling controversy showed us the importance of properly attributing sources, your sampling approach needs proper attribution to professional standards. Don't freestyle your sampling approach. That's a career-limiting move. Let's close with a rapid-fire sampling challenge. I'll describe a scenario, and you shout out whether you'd use statistical or non-statistical sampling. Testing revenue recognition for a Fortune 500 company with the SEC breathing down your neck. Checking expense approvals for a small nonprofit with limited transactions. Evaluating inventory count accuracy for a global retailer with billions in assets. What questions do you have about sampling risk, approach, or real-life applications? Drop them in the discussion board. And if you're struggling with this material, remember my virtual office hours every Thursday. I'm here to help you master this. I know some of this might seem technical, but trust me, mastering sampling will set you apart in your early career. The concepts we covered today took me years to fully grasp and practice. You're getting a head start that I never had. Think you've mastered sampling for controls. Next time, we'll dive into monetary unit sampling, where the stakes get even higher and the techniques even more powerful. Ready to see how we tackle substantive testing with mathematical precision? As the great Missy Elliott once said, I put my thing down, flip it, and reverse it. That's exactly what we'll do with our sampling approach next week. Until then, this is your Audit Sampling Guide, signing off. Stay vigilant, stay skeptical, and always, always document your sampling approach.